Let's jump right into this explainer. Today, we're unpacking a highly complex, frankly fascinating financial projection for 2026. We're mapping out the potential bursting of the AI bubble, and specifically how a crossover between rapid Chinese AI advancements and a highly leveraged US market could act as the ultimate trigger for a chain reaction. And look, this isn't just theory anymore. We actually have real data points and threshold breaches happening right now. So here is how we're breaking this down today. First, we'll look at the AI bubble setup. Second, mapping the dominoes. Third, the China tech timeline. Fourth, the deflation accelerants. And finally, number 5, who holds the bag? All right, section 1, the AI bubble setup. Let's start by establishing the immense tension that is currently brewing in the macro tech market. Negative $186 billion. Take a second to process that number. That staggering figure is the forecasted aggregate free cash flow for 2028 among hyperscalers. The massive tech giants building out all our cloud infrastructure. It's a massive plunge from a positive $180 billion just back in 2025. They are burning cash at a historic, unprecedented rate to build out AI infrastructure. To give you some context on just how rapid this shift is, Alphabet's quarterly free cash flow actually went negative in Q2 for the very first time since 2004. So the cash burn here is absolutely monumental. Because of this, we've got a really stark conflict happening right now. The credit markets at the edges are flashing giant neon warning signs, while the equity markets at the core still think the tech giants are totally invincible. On the credit periphery, we're seeing very real distress. CoreWeave's credit default swaps, which is basically insurance against them going bankrupt, well, they're pricing in roughly 50% 5-year default odds. Oracle's credit default swaps hit all-time wides after a rating downgrade that was specifically tied to their massive AI concentration risk. But then, if you look at the equity core, companies like NVIDIA are sitting at all-time highs, with options markets implying very low volatility. It's a total disconnect. To sum it up, the market is actively triaging the highly leveraged outer edges for failure, while assuming the cash-rich center is going to survive completely untouched. The market clearly sees the risk on the edge, but it believes the massive cash flows of companies like Google, Amazon, and Microsoft will act as an impenetrable firewall. But what if that center isn't immune? Let's move to section 2, mapping the dominoes. Before we knock over the dominoes, we have to talk about take-or-pay contracts. We need to understand these because they provide spending momentum right up until the exact moment they create a catastrophic funding wall. Basically, you're obligated to pay for computing power whether you use it or not. Right now, there are over $662 billion of committed leases and take-or-pay contracts in the AI space. This structure gives the market a total false sense of security. It cushions the top of the stock and guarantees revenue for 4 to 6 quarters even after the underlying business demand dies. But it severely strands the highly leveraged companies at the bottom. Okay, so let's trace the exact anatomical chain reaction of how a collapse transmits from that leveraged periphery directly into the equity core of the Magnificent Seven. Step 1, a massive anchor tenant, like OpenAI, hits a funding wall in the first half of 2027. They simply can't raise the roughly $100 billion needed to cover their burn rate. Step 2, Oracle's massive order backlog collapses in credibility. Step 3, this forces the hyperscalers to publicly cut their capital expenditure guidance. And finally, Step 4, the entire tech core violently reprices downward. This is absolutely crucial to grasp. This predicted collapse is not about the AI models failing to get smarter, it's about the companies running out of the cash required to sustain them. People keep looking for a technological failure, but the very first domino to fall will simply be a massive, unavoidable funding gap. The math stops working long before the tech does. Now, you might be wondering, how does a single private company running out of cash threaten a massive giant like Oracle? To understand that fragility, consider this. A staggering 54% of Oracle's $638 billion order backlog is tied to just one unprofitable private company, and that's OpenAI. If OpenAI is forced to stretch out or reduce its contracted compute because they can't raise capital, Oracle's backlog deflates instantly. Oracle is the exact node where aggressive startup risk crashes right into the investment-grade bond market. Now let's pivot to the geopolitical wildcard in all of this. Section 3, the China tech timeline. Chinese domestic AI training at sub-frontier levels is already proven. In fact, sub-frontier models running on domestic Chinese accelerators are already operating at massive scales. We're talking 2 to 3 times the scale of GPT-4. Plus, Huawei's Atlas 950 SuperPod is on track for mass production in late 2026. However, the timeline to actually match the US frontier stretches out to early 2028. A true massive frontier training run that relies entirely on domestic supply chains is still a couple of years out. Now, the real bottleneck here is domestic high bandwidth memory, or HBM. It's not the processing chips themselves anymore. Companies like China's SMIC already have the capacity to print millions of dies, even if it's at lower yields. But producing this specific type of high-bandwidth memory entirely within China is slipping in its timeline. That memory is the strict gating factor preventing total domestic independence right now. When we look at the probabilities of a strict domestic Chinese AI run at that massive scale, it tells a very clear story. A truly domestic Chinese frontier chip is fundamentally a 2028 story, not a near-term 2026 threat. Analysts estimate only a 5% chance of a completely domestic frontier run in 2026, which rises to 35% by late 2027 and hits 65% by the end of 2028. So the median arrival for this capability is early 2028. So the key takeaway here is this. China's near-term bubble relevance runs through economics, not through domestic frontier silicon. By 2028, the US frontier is going to have advanced even further anyway. But that doesn't mean China isn't impacting the US AI bubble today. It just means the impact isn't happening in the hardware space right now. And that brings us to a really critical synthesis, Section 4, the deflation accelerant. Which begs the question, if China's frontier chips aren't ready until 2028, how on earth do they trigger a US market collapse in 2026 or 2027? This is where the narrative really comes together, because China's true impact acts as the ultimate accelerant. It is not about them building a faster chip tomorrow, it's about what they are doing to the economics of AI today. The answer is massive price deflation. Cheaper Chinese models are just gutting the monetization frameworks of heavily leveraged US AI companies. Get this, the price of 1 million tokens has plummeted 214 times in just 40 months. We're talking a drop from $30 down to just 14 cents. Because of this insanely aggressive pricing, the US share of tokens routed through platforms like OpenRouter has collapsed from 70% to 30% in a single year. And astonishingly, 8 of the top 10 routed models on that platform are now Chinese. In plain English, right when these heavily leveraged US companies desperately need to show massive future profits to secure more funding, this deflationary pressure makes those profits look mathematically impossible. It completely removes their terminal value defense exactly when US credit stress is arriving. Remember OpenAI's funding wall in 2027? They are currently operating at a negative 122% margin. They absolutely need the future price of AI to remain high to justify those trillion-dollar valuations and secure the next $100 billion. But Chinese open-source models are rapidly driving the cost of AI to zero, erasing at defense just as the credit stress peaks. So when that credit stress meets this deflationary accelerant, who takes the hit? Section 5. Who holds the bag? The analysts break down the potential fallout into 3 mutually exclusive paths, ranging from a mild market rotation to a full-blown dot-com-style crash. The best case, with a 30% probability, is orderly digestion, where AI companies basically trade sideways and the weakest players just get absorbed. The base case, at 45%, is a controlled demolition. This features a 25 to 35% drop in the AI sector, but catastrophic broader damage is avoided. But then there's the worst case. Sitting at a troubling 25% probability is a credit-led cascade. This is the scenario where OpenAI fails its raise, Oracle gets downgraded to junk status, and the broader S&P 500 drops 30% or more. If we do end up in that base or worst-case scenario, the losses cascade down a very specific ladder, from first loss to last. It starts with the neoclouds, those newer, specialized AI cloud providers, and junior debt holders taking the very first hit. Then the pain moves to SoftBank, which has massive exposure to OpenAI. Next up are Oracle bondholders and shareholders, which bridges the gap to the traditional bond market. From there, it infects private credit LPs and data center securitizations held by insurers and pension funds. And finally, it hits passive US index holders. Ultimately, the biggest bag holder at the bottom of that ladder isn't some Silicon Valley VC. Surprise, it's the everyday passive investor holding index funds via their US 401ks. Because these massive tech companies make up such a huge portion of major index funds, a crash in the AI core acts as a staggering wealth effect shot for everyday people. Right now, equities make up a record 45.8% of US household financial assets. This isn't just a contained tech sector problem, it's a massive macroeconomic event. It is a really sobering reality that bridges high-level, complex financial mechanics right down to your retirement account. The bottom layer credit domino is already starting to wobble. So the real question we have to ask is, if the first domino is already falling in the credit markets, is your 401k braced for the chain reaction? The only question left is if or when that reaction reaches the core. That's all for this explainer of the AI Bubble Domino Map. Thank you so much for joining us and keep questioning everything.